What's up, everybody? It's Zoe Azubuki with Edge Home Finance. This is your market update, and today we are talking about big bank moves. And specifically, we're going to talk about one big bank that's making a pretty big move that's going to impact a lot of people. Not trying to pick on anybody here. We normally don't come on here and talk about specific financial institutions that's making specific moves, but in this case, Wells Fargo is a bank that has a huge share of consumer products, bank products, and it's going to impact a lot of people what they're deciding to do here. So let's dive right into it. Ultimately, Wells Fargo is choosing to close out all of their personal lines of credit. So they're going to do this within the next 60 days. And by the way, when a large bank like Wells Fargo does something like this, it's worth noting because it could be an indicator that other large banks are going to do similar or the same. So just fair warning. If you don't have accounts at Wells Fargo, this still could be something that impacts you later on, just because banks a lot of times do the same things in the same seasons, if you will. So, okay, let's talk about what this impact is going to mean for us. A lot of people's credits are going to just basically drop. Like, their scores are going to drop like crazy because you have a huge increase of credit ratios that are going to be happening when these accounts close out. People don't have the money to pay this stuff off, so they're just going to be left with balances. And with that line of credit not giving you the higher limit, it's going to impact people's credit ratios, and that's going to make scores drop. So it's kind of going to impact a lot of people. A lot of people may say to this, man, it's kind of a punk move for Wells Fargo to do something like this. Why would they do that, right? It's a business decision by Wells Fargo, and they can do this kind of thing. In the fine print of these loan agreements, banks are allowed to do this kind of thing. So it's kind of like within 60 days, either you shape up or shape out. You just got to deal with it, right? So what's our takeaways from this stuff? I'd say the first thing is it's a reminder that we can't really trust banks with unsecured debt. And when I say unsecured debt, I'm referring to debt that's not backed by real estate. So the second thing I would say is we should all be encouraged to minimize as best as possible our unsecured debt, our level of unsecured debt. Ultimately, debt-free is the way to be. When my wife and I, shortly after we got married, Michelle and I, we went into this program called Dave Ramsey's Financial Peace University. And man, it changed our lives. We paid off our debt, got rid of student loans, car loans, credit card debt, and all we had left was our mortgages, and it changed the landscape of our financial future, and we're reaping the benefits of that still today. So just a little side note, I definitely encourage you, if you've thought about taking it serious enough to try to pay off your debt, Dave Ramsey's Financial Peace University is a great way to do it. I know a lot of people out there have their opinions about Dave Ramsey. If you don't want to go with his route, try to find another route. But ultimately, paying off your debt and being debt-free is the way to be. So I know upon hearing that, a lot of people might say, well, Zoe, you sell debt. You're always talking about mortgages. What the heck? It's like, yes, okay, yeah, I sell mortgages. But here's the difference, right? Mortgages is backed by real estate, okay? And real estate is an appreciating asset. So debt that's backed by appreciating assets is generally good debt because you're leveraging something that's making you money over time, right? And as you pay those payments down, your appreciation increases, your equity between what you owe and what your asset is worth is ultimately going to allow you to pay off that debt and still have some money left over if you ever had to make such a move. So that leads me to my conclusion and potential solution for a lot of people that may find themselves in a predicament where accounts like held at Wells Fargo and a bank like Wells Fargo is making a decision like this. What you can do is tap into the equity of your current home to pay off that debt. Using a refinance cash out can allow you to do that. And we do it for a lot of clients. It's a huge game changer for them as far as their financial picture goes. It allows for your equity to be used to pay off the lines of credit, consolidate other debt, and eliminate a whole bunch of monthly payments that ultimately makes your cash flow going out less. And that is something the future version of yourself will definitely be thankful for. So if that's something you want to talk about, look into a little bit more further, definitely let me know. Would love to chat and flush through those ideas with you. And outside of that, I think that's pretty much all I got for now. But of course, feel free to call for anything at any time. We're always here to help. Until next time, take care and God bless.